It's about that time of year when farmers start getting fidgety about planting the winter crop. And there are always the same issues to ponder. Not enough rain, too much rain, plant early, plant late. And for an increasing number these days, sell now or sell when the wheat's actually in the bin. Well, what sort of season might be ahead? One of Australia's leading grain analysts, Malcolm Bartholomaeus from Pro Farmer, reckons it could be another cracker.
The rainfall events that we've had across eastern Australia, through Victoria, parts of South Australia, should set us up with good subsoil moisture, and it's come late enough in the summer period that most of it will be available for the growing season.
So bigger than last year?
Well, it will be bigger than last year potentially in the eastern states, but there is still a strong correlation between growing season rainfall and final production. So a bit like last year, we got through with very low growing season rainfall to have a good crop. If we get good growing season rainfall, particularly late in the season, it will really utilise this subsoil moisture and generate potentially a bin burster.
Bin buster or bin burster. That's what farmers like to hear. But even more important is the price, especially the price once the wheat is actually in that bursting bin.
I think all things being equal, and what we know about the global crop so far, you would have to say that the most likely outcome is slightly lower. But even though we've just had record global production and very high global stocks, the gap between production and consumption was only 12 million tonne. That's not a lot of room to play with for global stocks to come under a little bit of pressure.
Now, a couple of interesting marketing plays emerged last week. China bought 350,000 tonnes of feed wheat from Australia. There's nothing official, but market chatter has the price at $280 a tonne CNF into southern China. Pakistan sold 1 million tonnes of wheat to Iran, and elsewhere good rain in Europe and on the western plains of America put prices under pressure. So in Chicago, wheat slumped despite the weakening American dollar. Soybeans had the jitters late in the week on the back of the so-called slump in China. And as usual, corn went along for the ride with the wheat price. Local futures are under pressure because of those Chicago prices, although there's been a bit of a wait-and-see attitude, especially for Western contracts. Last Thursday, the ABS reported Australia's bulk wheat stocks at the end of February came to 23.3 million tonnes, down more than 2 million from January, but still an all-time high for the last month of summer. Spot prices hardly moved last week, with the exception of canola, which mirrored the price drop in Winnipeg. To livestock now, where the ongoing strong seasonal conditions continues to encourage restockers and push available numbers down. The National Livestock Reporting Service says offerings this year are down 8%, with a strong focus on lightweight veal steers for the restockers and backgrounders, and the Aussie dollar on the skids this past week will also give some heart to processors and exporters. Most of these prices are recovering drops from the previous week. That store cattle price is a good reflection of the amount of feed in paddocks across Australia and the overall positive outlook for the entire beef industry. Lamb and sheep prices were mixed. Quality was a key factor with a lot of plainer types available, and as restockers chased the younger sheep, this forced the processors into the higher weights, so the indicator ticked up a fraction. But mutton eased in all states except Victoria. Numbers were up and most weights and grades were on offer, and there's a fair bit of chatter about producers looking over their shoulder at the continuing strength in the wool market. Now the live trade, with very little action last week as some exporters try to load for ports other than Indonesia. There's still nothing official about the June quota, and the ministerial talks last week in Jakarta achieved very little, apparently. So steers ex-Darwin remain at $1.80 and heifers are at $1.65 a kilo. Dairy prices are steady. Latest forecasts have a slow decline in prices this year, about 5% for butter and possibly 1% for milk powder. But, and this is a big relative but, even with those falls, these prices will still be 20 to 30% up on the 5-year average. There's the current offerings, and on milk, it's hard to find a producing country where milk volumes are not actually on the rise. Now to New York, where cotton lifted a fraction despite the poor economic data out of Europe. It's worth noting that in this week of last year, cotton was trading above $2 a pound, more than double today's price. Some good exports out of America helped move cotton up, and elsewhere in New York, sugar futures rallied a fraction on the back of some uncertainty about the cane crop in Brazil. Finally to wool, where the market corrected from the spike of the previous week. Prices eased across all microns and might have been greater had not the American dollar slipped back as well. China was again dominant, with strong buying also from Europe, India and Taiwan. And here's a table of interest to wool producers where Australian wool is going. In the season from July last year to the end of January, China accounted for almost 3/4 of all wool sold at auction in Australia. Next was India, and then came Italy, the Czech Republic and Taiwan. And if you think China is dominant at the moment, the previous year it took well over 80% of all our wool. Prices in last week, the Eastern Market Indicator closed down 1.2% at 1,224 cents a kilo clean. Supply remains a problem, with future offerings well down on this time last year. And that's the Landline check on prices.